Okay, let's go ahead and call the meeting to order. It's 1:07. We're in the second floor HR conference room. It is November 30th, 2017, and this is our fourth quarter meeting. Is that right?
Third quarter.
Third quarter.
Third quarter.
And it appears that we have a quorum. So we're going to move forward. We can vote on any action items that are on our agenda today. We have approval of the second quarter 2017 minutes as our first item on the agenda. And I think everybody should have received a copy of those minutes. And at this time I would entertain a motion thereof. Okay, there's a motion and a second. All in favor say aye.
Aye.
Opposed? The motion passes unanimously. Item number 2, consent items. Funds that were not in the investment policy performance compliance for this past quarter.
None.
None?
None.
Okay. That's good news. Item number 3, third quarter market review and investment reviews for MassMutual, ICMA, and Nationwide.
Okay. Yes, sir. And I just want to point out that agenda item number 5, the continuation from the previous presentation from last quarter, record keeping consolidation. I've got some updated content that I think, move this along and can potentially, somebody could potentially make a motion to on which, how you want to proceed with it, because there's a couple of options we could, different directions you could take, and I don't know if you want me to cover that first, that it could be here to hear that. I'd hate for her to get squeezed out if we get to 4 o'clock and you have to go.
Well, I'm hoping you can finish.
Okay.
Item number 3 in an hour or so.
We should. Okay, fair enough. Just want it off. So we will reference the MassMutual book and start on page 6.
Yeah.
Which one are you going first? MassMutual.
Probably this one, maybe. Probably, maybe, sort of. That was my
And we'll start on page 6, capital markets overview. Risk markets globally continue to gain in the third quarter of 2017, led by international markets. It appears we are in the midst of the most synchronous global economic upturn since 2009. Our bullish global equity outlook assumes earnings estimates will continue to move higher as the global economy recovery persists and that valuations can expand as market participants become more comfortable with the sustainability of this recovery. As monetary policy fades, the only driver of market outcomes we see the reemergence of volatility that's associated with real interest rates tracking real economic growth. For the quarter, U.S. equities posted strong returns. Information technology of the S&P 500 was up 8.65%. Consumer staples was down 1.35%. Discretionary was up 84 basis points. They were the laggards as market discounts more potential downside than upside ahead. The U.S. had solid performance at 4.5%. Europe registered 6.5%, and emerging markets were up 8%. And China was a standout, up 14.8% for the quarter. The Dow Jones Industrial Average was up 5.6%. NASDAQ was up 6.1%. S&P 500 increased 4.5%. 10 of the 11 sectors, the S&P were positive. Technology was up 8.7%. Telecom was up, energy was up 6.8%, and telecom was up 6.8% as well. The laggards, consumer staples, were down 1.35%, and consumer discretionary, as mentioned, was up 84 basis points. Bond market was slightly positive. The Bloomberg Barclays U.S. Aggregate Index was up 0.8%. Morgan Stanley economists expect U.S. real GDP to be 2.7% this year. They forecast global GDP growth to be 3.6% this year. And if anybody's noticed, I'm sure you have, the last 3 days, the stock market's been on gone berserk. So 2 days ago it was announced that the quarterly GDP came in tracking at 3.3%, so that was a huge boost. Got some great corporate earnings. Got the hope of a tax cut that's passed, and the market, when I left my office, the Dow was up another plus 300 points today. So, yeah, just amazing. Commodities were up 2.5% for the quarter. U.S. economy, the Department of Commerce estimated that gross domestic product increased at an annual rate of 3.1% in the second quarter in comparison to 1.2% in the first quarter. Unemployment, the rate for September was 4.4%, up from 4.3% in May. Job gains occurred in manufacturing, construction, professional and technical services, healthcare, and mining. The number of unemployed was unchanged, a little unchanged, 7 million from 6.9 million in the previous quarter. The Bureau of Economic Analysis indicated corporate profits increased 0.7% quarter over quarter and are up 6.4% year over year. Inflation decreased in the U.S. One-year consumer price index is 1.9% in May and remains unchanged as of August. Morgan Stanley forecasts annual inflation at 2% for this year. Private sector housing starts in August was at an annual rate of 1,180,000, 1.4% above housing starts this time last year.
Wait, can I go back to your inflation?
Yeah.
You didn't even say inflation is decreased. And you have a positive number.
So year-over-year, inflation decreased. Year-over-year consumer price index was 1.9% in May. And is that what you're talking about?
The word increase.
Oh, inflation decreased.
It decreased in the quarter.
Well, this is the third quarter. Inflation decreased in the United States. The year-over-year consumer price index was 1.9 in May. Well, it decreased from the previous quarter. That's what that said.
It's like it's the same. 1.9.
Well, it does. Let's see here.
I didn't suppose I didn't call it in the months were down. So.
Yeah, inflation decreased in the U.S. The year-over-year consumer price was 1.9. It's been changed in August. I can certainly try to clarify that.
This is U.S. CPI.
Yeah. Retail and food services sales increased at a rate of 3.2% year over year in August, and 100 basis point decline since last quarter. Consumer confidence steadied in the third quarter of 2017. Consumer confidence reading of 109.8 after reaching its highest levels it's been since 2000 in March. The PMI index, which is a manufacturing index, increased with a reading of 60.8, a 3% uptick from June's 58.7. That's a tremendous increase. Anything over 50, the sector is expanding. Page 8, the table down below, S&P 500 up 4.5% for the quarter, up almost 17% trailing 12 months. Russell 2000 small caps up 5.7. Russell mid caps up 3.5%, and up in the text within growth and value of style, the Russell 1000 index, the large cap index was up 4.5% for the quarter. Growth was up 5.9, value was up 3.11. The mid caps, the blended index was up 3.5%, mid cap growth up 5.3, mid cap value up 2.1, and small caps, Russell 2000 was up 5.7%, with growth up 6%, and small cap value up 4.6%.
Those individual sectors are not on the table we're looking at. Right?
No, they're not. And then page 9, global equity markets. Down below, the ETH index up 5.5% for the quarter, up 19.3 for the trailing 12 months. Europe up 6.5%, up 23.2% last 12 months. Japan up 4.1 and 13.2 respectively. And then emerging markets up 8% for the quarter, 21.6% trailing 12 months.
Didn't make any money in the last 12 months, something should have
Exactly. And page 10, the bond markets, I mentioned the Bloomberg Barclays aggregate was up 0.8% for the quarter. Yield curve is flattening. We've got short-term rates have gone up with these rate hikes. We expect another rate hike in a couple of weeks, and the long end of the curve, the rates are going down. Interest rates during the third quarter did increase. The 10-year Treasury ended the quarter at 2.33% from 2.3% at the end of the second quarter. And then down below, you see high yield up 2% for the quarter, 9% trailing 12 months. Government bonds up 40 basis points, down 2% for the last 12 months. Mortgage-backed securities up 1% for the quarter, and up 0.2% for only 12 months.
Is it unusual to see such a spread between high yield and more traditional bonds?
It's interesting you say that. I've spoken to, actually I spoke with somebody from our bond fund about 2 weeks ago, the Western Asset Core Bond Fund, and we talked about high yield, because high yield, we look at this great equity cycle we're in, but we've also had a great cycle in credit, and spreads right now are very, very tight. And over the last 18 months or so, they've had about 7% exposure to high yield as what they call a plus sector, around the edges of the core of government bonds and investment-grade corporate. And they've actually tapered it off to almost 0% because they think high yield is fully valued at this time, and there's more value in other sectors. He actually pointed out that the intention is to get to 0% high yield because of the run we've had, and we have they're holding one position that's rated BB and expect to get an upgrade to get it above investment grade.
So it's a good time to get out of high yield.
Well, they think so. And that's where they position the portfolio.
It's been an unusually good year at 9%.
Tremendous. And then I was in New York at a Morgan Stanley event 2 weeks ago, and heard a very interesting speaker. That was a Morgan Stanley strategist that expects that the equity markets are going to slow down next year, particularly in the second half. And it's dicey in terms of the Fed policy, how rates, and we could get inflation, we can get a recession. There's a lot of things that could happen, but within the fixed income markets, within investment grade, 52% of all debt is held in BBB, because you have a lot of pension plans and endowments by investment policy paper. They can only hold investment grade paper, and if there is a credit hiccup, that some people think the credit markets, spreads could widen, and that could lead to damaging the equity markets. That if these 52% of all investment grade debt, if there are downgrades, and all those pension plans have to blow out of those positions to maintain investment policy compliance, it could get ugly in terms of credit spreads and the equity market. So it feels like a runaway party train right now, but we know it's not going to last forever.
I've got 3 main questions related to tax reform. I'm not sure where they best fit in the presentation. Do you have something you're presenting on tax reform?
No, there's a lot of stuff going around, and I don't know. I mean, there's stuff that I could present, but there's nothing concrete that I have brought to present.
Okay, let me just ask the questions.
Uh-huh.
So, depending on which version you're looking at, the House or Senate version, one of them, I believe, changes the treatment of 457s, makes them 141s. Are you aware of that or?
I've heard a little bit about it, but I don't know much about it.
They basically just lump them all back together.
That's the general idea. Yeah.
And right now, our members potentially benefit greatly from the fact that they have access to their money if they leave the employment year and or retire prior to 59 and a half, if they can get money out of it.
Correct. Mm-hmm.
If that penalty went away, fewer people might want to participate, or we might see fewer dollars flowing to our plans. I'm not sure.
Mm-hmm.
I'm not sure if the caps would change. I don't know what's going on with it next year.
The cap goes up to 18.5.
Yeah, the cap did go up to
Yes.
18.5.
That's the count.
Yeah. But the new tables, came
Yeah,
out.
the IRS released
Yeah.
new tables.
Yeah.
Yeah, and tax tables for next year are coming out too, but they might change.
Yeah. But I can certainly follow up on some color on the tax reform. There's different camps, different schools of thought as to, we just don't know.
Does Morgan have a division or a group that's working on this right now?
There's some stuff going around.
Okay.
Yeah. In the future, if there's any, with enough heads up, if there's any, particular points of interest, we've had a lot of resources. And if you ask me to bring something, I can certainly.
Well, some of this is pretty fresh. Like just today, I was reading an article about an potential impact on pension funds. Pension funds that the states run, the way that they invest the money may be subject to some new kind of income tax now, and that may change the way they tailor their investment portfolio, which they don't have time to change because this plan, if it's passed this month, actually goes into effect January 1st. So something like that could throw a pretty big monkey wrench in the pension, which some of this money is invested in pension.
Some of what money?
Some of the pension money
Oh, yeah.
is invested in the same things that we're looking at.
Yeah. Yeah.
Which could change the demand for it.
Yeah.
And then on the uni side, there's talk about getting rid of advanced refundings, which could affect the whole uni market.
That's right.
And right now, there's a big demand, a big run for unis, and so they're doing really well.
Yeah. And that would certainly change how you go about your municipal finance, for sure.
Yeah. So I think next year's going to be quite different in tax reform passes. I heard you say slow down in equities, but I think you say correction in equities. I heard other firms talking about potentially a fairly large correction. We're at 24.3 thousand now today.
Yeah.
Pretty pumped up from where it was a year ago.
I know. And we do have, something I can follow up with, we do have certain market forecasts that, three assumptions, a base case assumption with, modern economic data, a bull case, which, everything lines up lightning in a bottle, and we go further, and then a bear case, and we could be down, 20%, or that would be a correction for sure. But, certainly very interesting times.
With the traditional 10% correction is now like 2,400 points. That's a pretty big number.
Yeah, these levels.
Such a high number.
Yeah. We've been through it before, and that would certainly be a time to, educate participants, but education specialists with 3 record keepers, dollar cost average, don't abandon your portfolio. With Math Mutual, we've got $79 million in the general account now. In a market correction, who knows what kind of, discipline or lack of discipline is out there. We know there's a lot, and you can see that number go up.
If everybody rolls their money into the general account, Math Mutual going to come down and say, sorry, 4% done.
Interesting.
That's a good question. Voya, and this conversation is great. I love the dialogue, but Voya, at least with Henderson, they had 3%, and Voya, charging Henderson not just fund revenue fees to satisfy, but they also have a 30 basis point admin fee around the assets everybody except that general account. And boy, the way Boyd states it is that something has to support the payment of that 3%, and that was doing it. And then lo and behold, Boyd comes out and announces that as an insurance company they have to get approval for each state with the state insurance commissions. Then working their way back through Nevada, and they finally came forth and said, we're going to force your hand, and they actually put a freeze on the 3%. Any allocation of the general account will be now credited at 1.75. So any money currently in 3%, that will continue to accrue at 3%. But any new allocations going forward, it'll be ratcheted down to 175.
State mandated?
No, Boyd did, but they had to get approval with each state insurance commissioner. So, but so far Mass Mutual hasn't indicated that they are going to compromise 4%.
The Boyd is not an insurance company like Mass Mutual.
Yeah, they are.
Yeah.
Yeah, it's still ING.
Oh,
Mhm.
yes, I wouldn't be surprised if something like that.
Yeah, and if you tie that into any effort to try to consolidate record keepers, if you want something to force your hand and make it a lot easier to do it, that would sort of be it.
Okay, please proceed.
Okay. Well, thank you for the questions. Page 19. There's the watch list. Pretty plain. AMG Manager Skyline. Page 20 and 21 are the asset classes and the funds we have. On page 21, to note that on November 17th, the large blend of Parnassus Core Equity Fund was added, and that's the sociable investing fund. In mid-cap growth, Hospice and Wiley was replaced with T. Rowe Price mid-cap value. In large growth, Mass Mutual Select Growth Office was replaced by Corbridge large cap growth. And in another such a real estate and specialty sector category was replaced with Invesco, the real estate fund.
That was all the fourth quarter.
Okay. Page 24. There's the glowing $79 million in general account. Down below, later I will give certain mention to the assets in these index funds. You got the State Street 500 index, State Street mid cap, and State Street Russell 2000. Page 29, they were $163,211,000. Page 29.
Was the format changed for this?
No. Now, page 29, here's the new section that we added last quarter, so you can see historical watch list. And moving forward to page 33, there's the scorecard detail with the 9 criteria. Things are doing pretty well. We've got Hartford Total Return, we've got Core Plus Strategy, PIMCO Real Return, doing fine. Oakmark Equity Income, doing fine. That's a balanced fund. The 5-year Sharpe ratio last quarter was in the 62nd percentile. It did improve to 52nd, so that's a little improvement. We know the T. Rowe Price funds are dynamic in this equity marketplace. Page 34, see the whole series gets 100% score. Hartford Dividend and Growth, doing excellent. Oppenheimer Main Street, doing fine. The Mass Mutual Select Growth Ops has been replaced by Clear Ridge Large Cap Growth on November 17th, and the Hutchinson Wiley. Oh, and by the way, last quarter, Mass Mutual Select Growth Ops had a score of 22, and it declined to 11 this quarter. Hutchinson Wiley was 22 points, stayed at 22 points, replaced by T. Rowe Price Midcap Value, excuse me.
How were the two new ones that scored if they were in the quarter?
Well, I don't know. I'll certainly see, as of 12:30.
They would have beat these
12:31. What's that?
They would have beat these two for sure.
I certainly hope so, because, we just looked at them last quarter, and something would really have to fall apart for them not to even be in compliance. Page 35, mid-cap growth is doing great, small cap value is doing very good. So the AMG Manager Skyline has been on watch, and from the minutes of last quarter, been on watch, although fund scores 67, which is passing the IPACE criteria committee concerned by 57 percentile ranking for 3 years. And so for 3 years, it remained at 57. Excuse me, it was at 67. It did improve to 57. And on the 5-year number, last quarter it was 13, which is very good. It even improved to 4. And so, with a score of 67, clearly passing IPS criteria, I think it deserves consideration to be taken off the watch.
I'm okay with that.
Any comments?
I agree. As well.
Do we need a motion to take something off watch or consensus? Okay, is there a motion to remove AMG Manager Skyline Special Equities and from the watch list?
I motion to remove it from the watch list.
Maybe you have to read
I have to read the whole thing. Okay. I don't want to do that. Yeah.
All right, all in favor of removing it from the watch list, say aye.
Aye.
All opposed? That passes. This is removed from the watch list.
Excellent.
Thank you, John.
Small growth, doing fine. Ranking utilities, hanging in there at 56. Hartford Healthcare, rated 100. There's American Century, 11 is being replaced. It was replaced with Invesco. MFS International Value doing fine.
How are healthcare stocks holding up with the constant battle with?
Yeah, I think United Healthcare has been quite a move. That was one of the big movers in the last couple of days.
That's where I got most of
Okay, good. Well, what are you smiling
Looking large.
Yeah.
Look at that confidence.
29.7 this year.
29.7.
Oh my
Even
God.
401k.
In this
We don't have a 401k.
In the Hartford Healthcare?
So it's one of them.
Good for you. Your network is bloated.
One year?
I'll share the distribution. It's only amongst 3.
Yeah. Wow.
International
That's amazing.
values doing fine. And on page 36, Hartford Global, 100. And then page 37, there's the index funds, all doing fine.
Yeah. They look good.
So the markets, we've got good tailwind, and the funds in this lineup not only making money, but they're, for the most part, pretty compliant, so we're in pretty good shape. Next up will be ICMA. Jennifer, did you get your email?
Yeah, I sent it to
Okay,
Julie.
good.
Julie, did you get that email?
Yes, I have.
Okay, good.
All right, so we'll start on ICMA.
Yeah, okay, I guess I have an update.
Oh, okay.
What page are you gonna go to?
19. So, all the Vantage Trust, Vantage Point Milestone funds were on watch, but those are being replaced December 15th by the American Funds suite of targeted funds, which you approved. Just a sidebar comment on ICMA. I think I told you I'm part of a team that consults to $760 million Oakland County, Michigan, and I see it. There are two incumbent record keepers for ICMA and Fidelity, and we did an RFP to consolidate, and the winner of that was Prudential. But one element that had kind of soured part of the committee members with ICMA was that in past years, and I think maybe there wasn't a consultant to oversee things and hold everybody accountable, but ICMA, even as their plan grew and grew and grew, ICMA was not forthright to offer them less expensive share classes to keep them kind of market price, if you will. So lo and behold, and we're in an environment of all record keepers are open architecture, proprietary or not proprietary. It's about making the required revenue. And so when I went to Sean Baker, I said, the committee's authorized and wants to move forward with placing the Vantage Trust milestone funds with American Century, and he gets back to me and says, Freddie, I've been authorized to offer you a less expensive share class in the milestone funds.
This is the Vantage Point.
The Vantage Point, yeah. The Vantage Trust, Vantage Point Milestone series of target date funds. And I said, well, Sean, I think that the train's already left the station on this, and the committee has made a decision, analytical data to move forward. So unfortunately, I don't think that's good timing. So just a side note that was not a good dynamic as far as I was concerned. So I just feel I'm compelled to at least share that with you.
Have we already had some sent out notices to everybody?
Oh yeah,
Not like that.
yeah. So
So some of the things you gotta let them know on that.
yeah. So anyway, that's that. In small growth, Oppenheimer Discovery's on watch. And if you go to page 21 and 22, there's our funds and the asset classes. Page 25. And there's our fund balances. Page 26, we're at $57,477,000. Page 30. Now, right up on top, you see that the Valley Government Money Market Fund's been on watch, and I do have a fund search to show you for that. And you see that on the bottom of page 32, Oppenheimer Discovery is also on watch. You have a fund search for that. So page 34, there's our scorecard detail. So Jennifer, there's
Yes.
a tab on search.
Yep.
Now, interestingly enough, the Fidelity Government Money Market had a score of 33, below our threshold for compliance. And lo and behold, things have improved.
And it's
Yeah.
hard to read
Yeah.
on yours for some reason.
Actually, before you show the fund search, Jennifer,
Starts out with ice cream.
I do want to highlight page 34 of the book.
I'm sorry, go ahead.
Well, before you put the fund search up, I still
Yes.
want to just highlight something on page 34.
Okay.
That, the fund has been on watch. I do have the fund search, but interestingly enough, last quarter, the fund had a score of 33, which is below the 50% threshold we need, and it's improved to 67. And going into that improvement is over the 3-year peer group ranking. Last quarter it was 51st, it improved to 49. Over a 5-year period, it was 52nd, improved to 49. The alpha for 5 years was in the 51st percentile, it improved to 49. Sharp ratio was 81st, it declined to 84. But net, it has improved. So I can show you the fund search. There's only 51,000, but it's still plan assets. But we can look at the fund search, and then you can make a decision on either replacement or maintaining this fund and taking off watch. Okay. Now you. Excellent. Okay, page 7. And here's a situation where had a couple go arounds with ICMA and could really only come up with one fund that screened in because while they were, a pretty good selection that was approved by Morgan Stanley, when we got around to, finding ones, share classes and funds were available on ICMA, there's been so much movement going back to October of last year with the money market reform. All the retirement plans got out of the prime money markets and had to go to government money markets. A lot of the government money market funds that were otherwise available have closed due to capacity. However, you do have Invesco, short-term government agency, and it does score superior over 1 year, 3 year, 5 year, better alpha, better Sharpe ratio, lower expense ratio. If you go to page 10, you see the 1, 3, and 5 year annualized returns, year to date, 1, 3, 5, and 10, better for Invesco, better alpha, higher beta, better Sharpe ratio. And on page 14, it does come with a low expense ratio, 17 basis points as opposed to 43. So, the discussion is, do you keep the Fidelity money market because it's now in compliance, or is the appetite to make a change to go to a fund that, as this point in time observation, looks better?
Why doesn't Morningstar rate this category? It's because there's
I don't know.
these funds.
But, in a asset class that yields very little to begin with, if you look at page 10, little as it is, the Invesco does do, on a percentage basis, significantly higher in the year-to-date 1, 3, and 5 year returns.
And that's the fee.
That's, well, a lot of things is the fee.
Fidelity has been like so far below the treasury line.
Yep. Yep. So John, you bring up a good point. A lot of it would be the fee.
But if it's just I didn't see the waiver.
I'm assuming that's a 12B1 fee waiver date. Right.
Where are you seeing it?
Oh, right on the screen.
On what page?
Or whatever that column.
Oh, where did you see the waiver at?
This fee waiver date on the end.
Right here.
Oh, okay.
Yeah, so, as a 12B1 fee, 25 basis points.
All the returns are almost, they're average about double.
Yep.
All the returns.
Yeah, so I think you might want to entertain a motion to replace it.
Anybody willing to make a motion to replace Fidelity with investment?
I'll make the motion.
Then I'll second it.
Okay.
All in favor, say aye.
Aye.
Opposed? Fidelity has been replaced, so we'll do that in the first quarter?
Yeah, after the first quarter. Excellent. Back to the review book, page 34. There's the Western Asset Core Plus Fund, doing exceptional. Vantage Point Inflation Focused Fund is on watch. Last quarter it scored 22, it stayed at 22. And I would offer to do a fund search for next quarter.
I would say do the fund search.
Yep. Keep on watch.
Do we need to do that in the motion?
Not to do the fund search.
I don't think so.
Once he brings the fund back, then we'll do the motion to replace it.
The target date series, we're replacing all of them, right?
Yep.
So the one that I saw that had the most money, the first one on this list, which is actually doing quite well. Retirement, income, ARM fund.
Yeah, well, that has a lot of bonds in it. It's going to be very fixed income weighted.
So it's people that are already retired.
Yeah.
Yeah. That's as close as we get to a general type account in the ICMA series.
Yeah, from a fixed income allocation wise, for sure.
Is there something similar in the one we're series we're replacing as well?
Oh, yeah, absolutely. Okay, so Fidelity Puritan, a balanced fund, doing very well. Target date funds, we mentioned, are being replaced. Page 35. Got two large value funds, both doing pretty well. Large growth, Vantage Point, growth in income, score 78. Page 36. Fidelity Contra Fund and the T. Rowe Price growth stock is doing exceptionally well.
Been a good year after that. Last year they did really bad, this year they're doing great.
Yep. Wells Fargo Special Mid Cap doing great. BlackRock Mid Cap Growth doing great. Managers Undiscovered Managers Behavioral Value Fund doing well. Oppenheimer Discovery is on watch. Last quarter, for 1 year, it ranked in the 86th percentile. It did improve to 50th. Over 3-year ranking, it was 34th. It declined to 40. 5 years, it was 51st, declined to 62. 5-year alpha was 48. Last quarter, declined to 57th percentile. Sharp ratio was 56. it declined to 62nd percentile, and the 3-year performance relative to the index was 0.24 last year, declined to negative 48 basis points, and a 5-year return relative to the index was negative 1.17%, and it declined to 1.94. And last year, the score of the fund was 56. It declined to 44. So I would offer you a fund search.
It's not even on watch there.
Oh, excuse me.
No, it's been on watch, I thought.
Yeah, it's on watch.
We're talking about
Oppenheimer.
Yes.
how do I tell if it's on watch or not? I can't tell.
Well, I have a note, and we can go to, and I can tell you it's on
It's on
watch.
page 32.
Yeah.
It's been on watch for 3 periods.
Yeah. Yeah, so.
So this is
Oh.
small cap growth?
Yes, small cap.
Is this the only one we have in small cap growth?
Yeah, and you know what, I have a fund search.
Or do we have it here?
That watch is every quarter, so.
I beg your pardon, there's a fund search for nationwide. So, no, there is not a fund search, but so it should remain on watch, and I would do a fund search.
Agreed.
So the two columns were the right, the return compared to an index,
Mhm.
3 to 5 years. That indicates for the total of that period, right? Not
Mhm.
per year.
Yep.
How far below they are.
Yep.
So 1.94% over 5 years.
Mhm.
Potentially to an index.
That's right. Of the Russell 2000 Small Cap Index. Will do. Fidelity International doing fine. Moving Real Estate doing fine. On page 37, the index funds doing fine. And there's ICMA. Next is Nationwide.
Can I ask a question on page 36? So, we were just talking about Oppenheimer and the spreads to the index.
Mm-hmm.
So the Oppenheimer 3-year spread to the index was minus 0.48.
Mm-hmm.
So you being one, you said it's doing fine, and the spread is twice as big to the index, minus 1.09.
Talking about the
This is your real estate one.
yes.
So it's not doing well compared to the index, but it's doing well compared to its peers. So does that mean basically no mutual funds in this category doing well compared to the index?
Well,
Can we just buy the index?
that's another great debate and a great conversation point because, for about the last 3 years, there's been, first of all, that's why we have 9 criteria because not beating index or beating index is one of the 9. Another criteria is, obviously how you have it ranked in the peer group as it relates to, active management compared to index investing. There are some very large pools of money that have just given up and thrown the towel in of active management because the last few years, we know the market's on fire and there's been very little volatility. So it's been very hard for active management to take advantage of some sort of market disruption where they can go in and take a position or take a certain sector overweight, try to take advantage and position to outperform an index. That's the main reason that active management has been so challenged.
BlackRock's doing growth.
Oh yeah, I mean there's certain funds out there, and you seek to identify funds that the funds that score 100 are doing it, and when we look to replace funds, we always look to try to screen in funds that score 100, meaning they would beat the index. And there's no pat answer, but there are times when I'm sitting at my desk thinking, to heck with all these active managers. Let's index everything and
politely ask to leave your office when you're having those thoughts?
But
Will you politely ask to leave your office when you're having those thoughts?
no, because, it's a save fees, save fees dramatically, but at least in these plans, if you have a participant that, has conviction, one way or the other, there's an opportunity to index with S&P 500, index with mid cap, and index with small cap.
Is there a clean index for real estate?
Yeah. There's real estate index funds. And keep in mind, now there's even, index funds for growth style and value style. And we're going to talk about that later because you asked me to follow up on analysis on historical growth versus value. But the notion that if you index around the middle and got a blend, you're theoretically, getting the best of both worlds and getting the most returns of both.
Or you're hedging your bet.
Yep.
Okay. So we're switching to what?
Nationwide.
So that's still going problem.
Yeah.
Yeah.
Page 19. Okay, we've done a lot of good cleanup. Page 19, American Century Real Estate Fund is on watch, but it is being replaced on December 18th with Manning and Napier Real Estate Fund. Page 20,
What about
21.
the UBS one? UBS small cap group?
Oh, I beg your pardon. I'm sorry, I missed that. Yes, that's on watch, and we do have a fund search to see for that. And on page 20 and 21, there's the funds. And this is the one, we do have two large value funds and two large growth funds. The blue chip fund is doing extremely well in the T. Rowe Price category. Page 24. There are the fund balances.
Still on that money market.
And page 25, nationwide's at 40,476,000.
What's the 1.3 million sitting in cash? Is that just this transition money?
No, that's they explain it's basically it's in money market that is part of the managed accounts within Nationwide. Nationwide has some managed accounts, and that's the cash that's in those managed accounts.
There's no option to put money in cash, right?
No, we're not. Plus, it wouldn't earn much.
Well, the money market's not earning much either.
No.
And that's the biggest fund you got in this whole
Yeah.
portfolio.
Yeah, actually, the money market is actually the fixed account. There's just a,
All there is.
yeah, this is just a placeholder.
What's the fixed
Work.
account returning?
It's returning 3.3%.
Oh.
Yeah, no, not bad at all. Yeah, this is a situation where Morgan Stanley doesn't, if it's a stable value fund that Morgan Stanley doesn't approve, then it's going to come up as not approved, and it's just a placeholder on software that lumps it all together. But it is in fact the fixed account, the general account for Nationwide. Page 33. scorecard detail. Okay, you can look at 29. It's clean. You go to page 31, and there's the UBS small cap, been on watch, American Century that's being replaced, and we're going to look at a fund search for small cap growth. And so on page 33, looks good. Very good. Page 34. Looks very good.
Delaware Valley having a hiccup this year.
Yeah, no, Delaware Value, it hasn't been on watch, but I've had a note to monitor it, and it's doing fine. I mean, over 1 year, last quarter it was in the 99th percentile. It did improve to 93rd. Over a 3-year ranking, it was 39th. It declined to 49th. Over a 5-year ranking, it was 32nd, improved to 21st. 5-year alpha was 14th percentile, improved to the 10th. So a top decile there. Sharp ratio was 10th percentile, remained at 10. But steady. Steady. Oppenheimer Main Street, hanging in there. There's the two T. Rowe Price funds doing extremely well. Blue chip growth, in comparison, is more of the big mega large cap growth funds. The value is doing fine. Page 35. JP Morgan Mid Cap Growth doing well. American Beacon Small Cap Value doing well. UBS Small Cap Growth had a score of 33. Last quarter declined to 11. And we can look at fund search. This is for UBS Small Cap Growth. Yeah. And so if you go to page 6, please.
Page 6 of the
Or the fund search. And so that incumbent fund, UBS, is going to be compared, lined up against Nationwide Geneva and Victory, Roberts and Stevens Small Cap. Page 9. Both good funds. Here's where you get into some nuances and try to pick a fund that you're more comfortable with, that you think would have more repetitive qualities in different market conditions. But these over 1 year ranking, Victory does better. Over 5-year ranking, Nationwide Geneva does better. 5-year peer group ranking, Victory does better. Alpha, which we're going to talk about here in a minute because it's very relevant. Nationwide, 9th percentile. Sharp ratio, very important. We'll talk. I mean, both are good-looking metrics, but in the 12th percentile. 3-year outperformance for the index. Nationwide Geneva over 3 years does exceptionally well. It does outperform the index for 5-year, but Victory outperforms it more for 5-year. Both of them score 89. If you go to page 10, here I know you do look at Morningstar, so here's Morningstar representation. Both are solid. Nationwide Geneva does register 5-star for 3 years.
Let's look up Victory.
Interesting. Well, this is. Oh, you get a different share class?
Steve dyslexic.
Transposed. ETFs. Now, on page 11, all three of these funds are, you see the MS status, and I might have explained this, I think I have before, that Morgan Stanley has one of the largest research organizations in the world. It's proprietary. We don't sell the research to any other firms. It's for our own clients, but its Victory is on our approved list, and even though UBS is under pressure under our investment policy criteria, it's also an approved list. But the Nationwide Geneva is a focus fund list, meaning our analysts have a higher conviction on the fund's strategy. And if you look at page 12, here's where we get into the nuances. And so you see for the quarter, Victory outperforms. Year to date, Victory outperforms. Over the 1 year, Victory outperforms. Over a 3 year period, Nationwide outperforms. Over a 5 year period, Victory outperforms. And you see the rankings down below, that when you get into the risk and performance metrics, Nationwide Geneva has a very high alpha of a 343. It has a low beta of 74. It has a very high Sharpe ratio of 117, and it has a lower standard deviation of 12. And so, when we're in a market that, over the past year, small cap growth as a category is up 20%. And if you do believe, well, not at some point the market will slow down, then I would emphasize those risk metrics.
Higher risk has generated almost 11%.
Pardon me?
The higher risk has generated almost 11% greater return over the last year.
That's right. So I wanted to show you, and both of these funds are compelling choices, but I wanted to just show everybody that.
Does Nationwide just partner with a company called Geneva to develop this fund?
Yeah, that's done all the time when it's basically, you have a portfolio manager, a fund company that needs distribution, and they need somebody to, embrace it and put the banner on it. So Nationwide, it's a Nationwide fund, it's sub-advised by Geneva. And I'll just point out a couple of things to highlight, on the first page. And I've spoken to Bill Bridge, the analyst that covers this. While Geneva Capital has had recent investment team changes, including philosophy investment professionals, key areas of concern, our GEMA, that's our global manager analysis, believes the current investment team is comprised of long tenured experienced portfolio managers and younger portfolio managers and research analysts, which represent the next generation of Geneva's investment team. They'll use the same philosophy. The strategy's historic performance pattern has exhibited lower beta, lower downside capture, and conversely lower upside capture relative to the benchmark over multiple periods of time. Second page, positive attributes, high quality investment professionals, time-tested investment process. Points to consider: a low turnover strategy. The portfolio exhibits a high quality growth bias. Areas of concern: Geneva announced multiple changes to the investment team, which manages both small cap and mid cap products. Co-manager Michelle Picard decided to retire. Co-portfolio manager Amy Crone announced her intention to retire. Fourth quarter of 2018, co-manager Bill Creevy announced his intention to retire no later than 2020. With the option to continue beyond the same time period, senior analyst Jose Munoz was promoted to co-portfolio manager. Portfolio expectations: portfolio is expected to outperform in a high-quality market environment, underperform in markets that are more speculative. Additionally, the portfolio is expected to outperform in down markets given its focus on quality. The strategy's performance is historically reflected lower beta, lower downside capture, and conversely lower upside relative to the market benchmark, which is reflective of the quality bias in the investment process. So I just put this into context of, looking at the high alpha and low beta and high Sharpe ratio. So when you're looking at a replace a fund that needs to be replaced, and you then, overlay a level of conscientiousness with respect to where we are in the market cycle, it might make sense to take the less aggressive option, knowing what historically the fund has done in up markets, has not captured as much of the upside, but is much more user-friendly in down markets.
This is a different share class though than what you're showing us, right?
This is a commentary on the portfolio itself, the research.
You get different ticker symbols.
Yeah, this is the underlying portfolio itself, making up the characteristics of how they run it.
Question for you, man. Hope you don't find this question offensive.
Okay.
Does Morgan Stanley receive any kickback from the different organizations?
Absolutely not. Absolutely not. Absolutely not.
So your recommendation is the new over the bigger?
That's my recommendation, because I think it's more appropriate in where we are in the market cycle.
Given the improvement in our current choice?
Well, both funds would be an improvement. Yeah.
So this is owned by Janus Henderson.
Pardon me?
This Geneva fund is owned by Janus, the former Janus, current Janus Henderson.
You're looking at structure?
Name of owner, Janus Henderson PLC.
Yeah.
Multiple levels of.
Yeah, it talks about the, the entity. So, yeah, Janus Henderson. And on page 3, down at the bottom, Henderson Group announced merger with Janus Capital Group in fourth quarter of 2016, which just closed the second quarter of this year. So yeah.
Those are nationwide presentation. John?
Yeah.
Would probably lean towards
Let's not forget about John.
The nationwide one. But
None of our other plans have this fund, right?
Right.
Either of these funds.
That's correct.
We have a choice between 2 4-star funds. Both are doing better than the index.
and they've been trading back and forth, which one does better year after year.
You see, I'll point out one thing, is that a participant, if you're a participant and you're shown the returns of these two funds lined up, most participants are going to take the victory. But if you try to take a higher level of understanding and knowing the respective portfolios, and they don't have the benefit of necessarily seeing what we see in the in-depth management research and the real portfolio characteristics that we would hope are repetitive qualities.
And the thing that makes me nervous about the Geneva is the changeover in the investment professionals.
Yeah, so
Its heyday was more 3, 4, 5 years ago. But Victory's been doing well recently, and now you've got to change over investment personnel. That's the part that makes me a bit nervous.
yeah, and that's a concern, but I have seen in certain situations where our analysts that when there's a manager change, the analyst will look into it, and there's been situations where the manager change has reflected in a downgrade from either focus to an approved, or if it's an approved fund, to it being not approved and basically, kicked off our platform. And sometimes the manager of research comes back and saying, we're comfortable with the way things are, but we're continuing to monitor it. But, I've spoken to Bill Bridge on a number of occasions, and, if he thought that it was going to be an issue, and his research and commentary indicates the contrary, that he's very comfortable with these people that, have been part of it and are coming up, and, the process, he's not going to change.
Well, there's anything you can do with the for the reading of 1 year time.
Yep. And Bill Creevy's got till 2020, at least.
That's fairly small. Let me get it down.
Yeah.
Well, I've noticed. Yeah?
Okay, anybody want to make a motion?
Move to replace UBS with Nationwide, please.
Okay, for a second.
Second?
All in favor, say aye.
Aye.
Any opposed? That passes unanimously.
Beautiful. Okay, back to page 35 of the review book. Ivy Energy, doing fine. American Century Real Estate is being replaced with Manning and Napier. Ivy International, doing fine. Thornburg Global, doing fine. Page 36, there's our index funds, doing fine. Any other questions or comments on Nationwide?
How come page 36, you've got different criteria than you don't have 35 and 30 next one?
Yes, so we removed the two data points comparing themselves to the index.
Because the added amendment, no, that's because.
Yeah, because, with the expense ratios, they're guaranteed to fail those two criteria, so it's not fair. So we just take out those last two criteria.
Is the
And
manager
that-
tenure the age of the computer managing the index?
And by the way, Gary, that is indicated and referenced in our investment policy statement.
Actually, what does manager tenure have to do? What is the point of that for an index fund?
No, you would think it would minimize the weighting of it,
Yeah.
the significance of it. But
Because most of those are just computer generated. As the index changes, they define.
pretty much, if something falls out of the index by market cap, it will be replaced. Hence the lower the cost. No research involved.
Yeah, the guidance on an index fund, it has to follow the fund, the S&P index with the 500 allocation to the second decimal point, or is there some discretion for a manager to heavier weight a specific stock in the S&P index, or is it just follow it?
No, it's usually market weighted. Yeah.
Okay, where we go next?
Okay. We are going to go to our next agenda item.
Approval of investment policy statement.
Yeah, so I included this on the agenda. The committee approved the criteria of the new 9 data points, 7 for the index funds. Via email, I distributed the document itself, and in September, all 7 committee members unanimously approved to adopt that new policy. And so the minutes of this meeting will reflect that.
Okay, that's one reason why it's on the agenda.
Yep.
It took a while to get things on, but.
Yeah. Okay, there's this attachment, Jennifer, of growth versus value. So I just use the small caps, and when we look at the capital markets overview for this particular quarter, I actually think the last quarter too, if my memory is correct, is that growth recently has been doing better than value. But this takes the last 25 years. You know, sometimes we look at returns of annualized periods, 1, 3, and 5. You could slice the data many different ways. This is simply taking a calendar year. Not that the market moves in, from January 1st to December 31st, but for the last 26 years, I can tell you that on the left, I have circled where the Russell 1000 value has done better, and on the right, I've circled years of the Russell 1000 growth has done better. And I can tell you that it's a tie, 13-13. It's a tie. And then, lo and behold, in the middle, the Russell index, blended index, is in the middle of it. Just like the capital markets overview indicated for growth versus value. So,
I think it surprised me the most was 2008, which is the worst year in 8 years or whatever, and they're almost the same.
In 2003, also the
Yeah.
increase is like
Interesting.
0.05 or that close. That's amazing.
yep. So, Morgan Stanley comes out with their model portfolios. I think I've shared with you, and at certain times in the growth cycle, they'll have an overweight or underweight to growth or value, and sometimes they have an equal weight. And where you can, in fact, as we do offer growth and value in these plans, there's always the option to have a super simplistic fund lineup of index funds, and depending on the sophistication of your participant audience, you can actually make an argument to have all core indexes and have less decisions people would have to make, and always keep them in the hunt, so to speak. It doesn't right or wrong, it's philosophical, but there's your analysis of growth versus value.
What's interesting is that coming out of the recession with the 2009 number, that's the year that probably the biggest change, biggest difference.
Mm-hmm.
The growth came back, roaring back from what it lost, got almost all the way back in just a couple of years.
Mm-hmm.
The value took a lot longer.
That's right. Yeah, in 11, you gave up.
Growth declined a little bit more than value, which you would have expected, but not a lot more.
Yep.
Then they're almost equal again in 13.
Now the market's doing really
Yeah.
well.
Mhm.
Value seems to be doing better.
Well, this third quarter, growth did better. Yeah.
This is only for the second quarter.
Right.
So it's about 17 million dollars.
What were you trying to teach us here?
I think I asked for this. This is a question that I had about, we got in our mix of funds, we have growth stocks, we have value stocks,
Gotcha.
funding stocks.
It is interesting.
Some of our plans, we have less of some and more of others, and just trying to figure out if it made much sense to spend a lot of time talking about making sure we have enough for each type.
This has come up a lot in my career over the years at different times, growth versus value. So there's no
mean,
Still dynamic?
generally speaking, right, the volatility of growth is greater.
Oh, absolutely.
Variations are generally higher.
Absolutely.
So this is showing you, I guess, that if you're gonna just keep your money in and let it ride, I guess it doesn't matter much. If you're gonna play the market, maybe it's just gonna.
Yeah, and not just let it ride, but dollar cost average,
Yeah.
and mitigating the amount of volatility by dollar cost averaging.
I mean, the tendency of people during when the market crashes a lot is to pull out of growth, right? And they're missing the big upswing that seems to come right after.
Yeah. But even
Like the safety.
yeah, but even more so, more drastic, the flight to safety is pulling out all the risk assets going to stable value. And then running the risk of, trying to market time, and nobody can get that right because, the undisciplined investors get out and wait till the market recovers and is up 15%, and then it gets back into the top, and, that's not a good strategy.
What is interesting to see these numbers every time, except maybe 2001, 2002, around 2007, 2008, there's quite a big jump after the decline, historically in the 90s and stuff. When it goes down, like 5.4, it's up 37 next year.
Except on, yeah, the huge increase in
Yeah, capital markets are usually ahead of economic data.
But even when you lost in 2007 and 8, you got a good portion of it back in 2009 and 10, if not. Just stinks if you had to retire in 2008.
probably those of you, a lot of investors, went on the sidelines.
Yeah.
Once you go to money markets, and they wanted to get on it.
If any of these numbers, I'm going to tell you, if you can hack it, you should just stay. If you don't need the money, if it's in a 401k, it should just stay in.
Absolutely.
Or if you're not, you don't need a house next year.
People that were getting ready to retire in 2009, once they got the
Yeah,
prosperity
yeah.
values.
Right. And in general, a lot of the carnage for wealth was that it comes down to being financially responsible. A lot of investors that had a lot of debt, a lot of leverage in real estate, and had to refinance, and assets wouldn't appraise, and they had to sell good assets to meet their debt obligations. That was a big ugly mess.
Yeah, that's the problem. Sometimes you don't have a choice but to sell.
Right. And then again, it goes back to not managing your own personal balance sheet as well as you could have, taking on too much debt. But then the other hand is, in tremendous market volatility starting in 08 through 09, they happened about 18 months long. The investors with dry powder, investable capital, have the great ability to, when weak investors sell in fear, people with money can then feast an opportunity and use that volatility dollar cost average, and then they always come out on top.
The rich vultures.
Yes. So there you have it.
Okay?
Okay, sure. You talked earlier briefly about the inability to capture gains because of the lack of market volatility and across the sectors. Is that sort of the reason why hedge funds are doing so well?
Well, first of all, what I said is that it's been such a harmonious market.
Every vote is going up. There's
Yeah.
not a lot of votes sinking.
That's
There's not a
correct.
lot of ability to
There hasn't
capture.
been a lot of volatility.
Yeah.
So we're talking about active management has, for the most part, underperformed passive investing because there hasn't been market disruptions for them to do something significant that might result in some outperformance. Might render out some outperformance to the index. What was the other?
Why hedge funds have
Oh.
been doing particularly well. There's been a lot of articles recently about
That's right.
institutional investors getting out of hedge funds and switching to indexing.
That's right. That's right. You've given up returns by using hedging strategies, but going to the next market cycle, I think you'll see some money migrating back to some hedging strategies. Yeah. Alrighty. Vanessa, you have to leave at 4?
I've got to leave a little bit before to get
Okay.
ready for the meeting.
Okay.
So actually, kind of going to leave now.
Okay.
You don't want
So-
to hear about the record keepers?
I just need to get ready for my 4 o'clock.
Okay.
Okay.
Oh, it's 2:30.
No, that says,
That's
oh,
fine.
sorry.
It's only.
I was just looking at
That
that.
says
It's
3:30.
only 2:30.
Oh, never mind.
Okay,
Never
you know, I was
mind.
looking at that.
That went really fast, okay.
We don't have anybody that.
I'm sorry.
Oh,
We're good. I kept looking at that thinking, oh, I gotta leave. I'll just go to the-
You want to talk in still?
No. Thank you.
Thank you. So I'll preface this presentation by saying, with City Henderson, we completed the RFP. We got 11 responses, identified 4 finalists. Finalist presentations came in. Henderson, 457, very small amount of 401 assets. They have about 18 million in retirement health savings plan assets. Altogether, it's about 150 million. Las Vegas today is about 261 million. And, the 3 incumbent record keepers for Henderson were Voya, ICMA, and Nationwide. And we had 4 finalists that were Mass Mutual, Empower, ICMA, and Nationwide. And I'm authorized to tell you because it was announced earlier this week. The decision was made, it was formally announced, and the record keepers were informed that Empower won it. Empower. Yeah, so Empower was the old Great West. It was the amalgamation of Great West, Putnam Record Keeping, and JP Morgan Record Keeping. They're out of Colorado. Big presence in the government, municipal sector. And in, bless you.
Thank you.
In Henderson's case, we had gotten a blind quote. They had an average weighted record keeping cost of 33 basis points. And we got a blind quote from a record keeper that was 12 basis points. And that got us, very excited. And we went through the process of talking to senior management and getting everybody on board. And we got, taking it a step further, kind of moving the ball down the field. And then we went to RFP. And I'll be darned if that 12 basis point blind quote we got was the highest in the RFP process. And so and the record keepers submitted record keeping quotes in 2 ways. If you use their non-proprietary, meaning if you didn't use their proprietary stable value fund, because the stable value fund, that's where they make a lot of their money. It's a spread product. And you could say the cost of that fund is the spread you give up between what you're crediting and what the portfolio is earning. But there's no transparency in the general account, as we know, the cost. And then we were also getting bids on if you use a proprietary stable value fund, it came with much lower record keeping costs. At the end of the day, when you factored in the lower record keeping costs than the Tower did, and we also took into account the crediting rate, where in their case of their 150 million, they had 25 million in stable value. They're going to save about $400,000 a year, every single year. So it even exceeded the what we had hoped for. So it's just a tremendous success story. So we took that, and this presentation might look familiar because I showed this to you, something that I did for a corporate client. And so I'll take you through this, and your current, we're looking at the current plan cost now. So from the top, you see the average weighted record keeper cost between three is 19.2 basis points. Morgan Stanley's annual consulting fee is $105,000. If you divide that $105,000 with the $261 million, that's 4 basis points. So the total required revenue to administer these plans is 23.2 basis points, but we're only earning 22.1 basis point, and the difference is that 15,000. If you remember, when we effective January of this year, when we got the record keepers to lower their required revenue so they would absorb the consulting fees for Morgan Stanley instead of the city paying that, if everybody remembers that, and that goes to Mark Vinson's concern that if there is a recession, your tax collections are down, there's budget cuts, he would hate to lose funding, budget to pay the consultant. And so we put that, we baked that expense into the plan assets. But, ICMA was very cooperative, accommodating. So was Nationwide Mass Mutual. They got this general account that is always a factor. So they met us halfway. But City of Las Vegas still pays $15,000 a year. So it's not perfect math because with 261 million, there's a lot of rounding here, but essentially that 2 basis points, 2 or 3 basis points comes out to $15,000. So on the left, or down the middle, you've got the weighted expense of the plan. That's 57 basis points, and that is the participant's cost. And so you've got 57 basis points on 261 million comes up to $1,479,000. If you add the 15,000 the city pays, you're really at $1,494,000, let's say. Now, I've highlighted in yellow a couple things just of note that are relevant. Nationwide, you've got that fixed account, 7.1 million. They do quote a 65 basis point expense for that. Now here at the top, where you got the weighted expense of 57 basis points, and you see the expense of the funds starting at the top, American Beacon, 1.15%. The revenue, the expense on $1,032,000 to the left, 1.15% is $11,876. Now that fund does share revenue at 35 basis points. Everybody with me there? And so if you take that revenue all the way down and on the second sheet and the third sheet, because this spreadsheet includes all 3 record keepers, that comes to a weighted average of 22 basis points. That's $577,000. But the problem is, not that it's a problem, this is just the revenue generation model that is in place now, that is going to the record keepers, okay, to pay their costs, to pay Morgan Stanley's costs. So the participants aren't getting the benefit of that revenue sharing because the 57 basis points minus 0.22, the net cost is 34, but the participants aren't realizing that. They're realizing the cost of 57. Does everybody understand that in that regard?
Not really. You're saying that the participants aren't getting the revenue share?
That's correct. It's going into a collection account that pays record keeping costs and Morgan Stanley's costs.
But those costs would have to be paid one way or another.
Yes, but I'm going to show you a better way to do it.
Okay.
But before I do that, on this current plan cost presentation, on the second page, where you've got the Mass Mutual assets, there's that $79 million in the general account, and as we've talked about it many times, the general account doesn't come with an explicit expense. Okay, so if you had a general account that had an expense associated with it, that $79 million at such a weighted bucket of money, the cost of this plan would be much higher. But that's just the nature of the general account. You get a higher crediting rate, you get no transparency in costs. So you go down the VT Plus Fund for ICMA, by comparison, as a collective investment trust with a transparent expense ratio of 82 basis points. And then on the third page, there it is, 261 million in assets, times the weighted expense of 57 basis points is $1,479,000. You have to add the 15,000 that the city's paying. So that's the current cost. Now, if you look at the proposed cost,
Is the revenue being pulled aside for this group to use for purposes?
well, there is no more money set aside. That's it. But we could always set something up, and you've referenced it before, and if you wanted to, quantify the cost of airfare and hotel lodging and the cost of, you could go to NASA. That's right. And, that would be a worthwhile.
Could we use the 15,000 the city's money?
Well, that's going to pay Morgan Stanley. And maybe you have a budget outside of the deferred comp plan to send you to NACA, but it certainly could be built into this as a qualified expense.
Was there any promise to the participants that the city would always pay 15,000?
Well, the promise isn't really about the city. Your contract with Morgan Stanley to pay $105,000 a year to Morgan Stanley, and the plan is only generating $90,000. So if you wanted to cover the whole $105,000,
The plan generated 577,000.
no, that's the cost. But there has to be additional cost, because if you look at the current plan cost here, the weighted record-keeping cost is 19.2 basis points. There's another 4 basis points required for Morgan Stanley, so that's the required revenue is 0.232 basis points. But from the funds, the revenue sharing expense ratio, and revenue sharing, it's only generating 0.221. So in order to cover, another 2 or 3 basis points so the 15,000 isn't paid by the city, in one of the 3 record keepers, you would essentially have to switch out a fund that had a higher expense ratio and came with a higher revenue sharing. So we've done well in negotiating with record keepers to get it down to where it is, but Mass Mutual would only budge so much.
So when you've been showing us funds to look at, you've been showing us expense ratios, but you haven't really been mentioning anything about the revenue sharing.
Yes, so when we look at funds, I look at funds that, look good performance-wise, would meet the investment policy criteria. Then I have to go to do the exercise of go to each record keeper and say, okay, here's a Fidelity large cap fund, here's an Oppenheimer large cap fund, and here's a T. Rowe Price if we're looking to replace a large cap fund, and say, now show me what share class, because obviously we want the least expensive share class, show me what share class you can offer that's on your platform that is the cheapest to Vegas, but also has enough revenue sharing to keep this thing at even par. So, but in the new model that I'm proposing, that exercise can go away. Yeah. And so this is what we've inherited, and I consider this what we have in place outdated. So in the proposed, now, Julie, do you have any questions?
No, I'm following along. You already know how I feel about this. I'm infuriated with Mass Mutual that they weren't willing to work with us any better than they did. So,
Understood.
I mean, we've talked about it several times, Freddie, so you know where I am.
Yep, I do. So on the proposed, so what I did here is weighted record keeper cost. I put 5 basis points. You can put anything you want, but you know we need to be realistic. So this is hypothetical, and so if you go back to, you know, the fact of the matter is, I did get a blind quote from Prudential. It could have been anybody, and they quoted open architecture 8 basis points of revenue of record keeping costs. Granted, right now we have a blended weighted cost of 19.2 basis points of record keeping costs. So Prudential, on a blind quote basis, quoted 8 basis points for open architecture and 6 basis points if you use their proprietary stable value fund. And that's the same thing happened on Henderson. Now, it just so happens that Mass Mutual, quoted pretty low on Henderson. Ultimately they didn't win it. But so I'm using 5 basis points as a hypothetical record keeping quote. Ultimately, we would never know unless we went to RFP. But I'm using Henderson as a pretty solid example, a recent example of what some of these price quotes came in on 150 million, where we have 260 million. So if you take the 5 basis points, a hypothetical record keeping cost, Morgan Stanley. Now there's a lot of work associated with this, particularly because there's 3 record keepers. It's like 3 different plans, a lot of moving parts, a lot of time spent behind the scenes, coordinating, follow-up, etc. On a consolidated basis, it would be my pleasure to lower the Morgan Stanley fee from 105,000 to 95,000. Okay, 95,000 into 261 million is 3.4 basis points. So now the required revenue would be 8.4 basis points instead of 23 basis points. And so now what you can do is you can take the weighted expense of the funds goes from 57 basis points on the current to 0.45. And I'll show you how that works. So what I did is I took our existing fund lineups across 3 record keepers, consolidated, all the large cap growth funds across 3 record keepers into one, and I will show you a perfect scenario of how you aggregate your assets to get lower investment costs. So if you look below and you look at the T. Rowe Price Blue Chip, that is one of our large cap growth funds. Okay, in the large cap growth between the 3 record keepers, we have $15 million. Now, if you look across at the current plan costs and look at the T. Rowe Price Blue Chip that is in Nationwide, we have $1,704,000, where the expense ratio is 72 basis points. Its share is 15, and the net is 57 basis points. Everybody see that in the front? Huh? Okay. Well, lo and behold, at a $15 million combined cost, you qualify for T. Rowe Price's collective investment trust at 46 basis points. It doesn't share any revenue, so the net cost is 46 basis points. That's a perfect example of aggregating assets to qualify for lower share classes. Now, on some of these funds, let's take example Western Asset Core Plus, another weighted area, and at the current fund that is in Nationwide of $2.2 million, where the cost is 83 basis points, it does share 45. It doesn't get credit back to participants. The net's 38. But with Western Asset Core Plus, you get this share class that's 45. It shares 15 basis points, and the net cost is 30. So I can, and the biggest example of this would be in the target date funds. On the second page, we have almost $35 million in there. Now, if you look at the T. Rowe Price target date funds, that's on the first page of the current, the longer dated vintages, because they're more equity heavy, are more costly than the more recent vintages that are more bond heavy. But if you look at to the right, the net cost, ranging from 44 basis points to 53 basis points, and compare that to the T. Rowe Price, where we would qualify for the collect investment trust at 46 basis points, you can see the power of that, how much money you're saving investment costs. Now, if you go back to the first page on the proposed, you see where certain funds, you get a share class that doesn't share any revenue. For instance, the PIMCO Real Return, the cost is 45. It doesn't share any revenue, so that the net cost is 45. On the funds that do share revenue, and by the way, the exercise is to, with each fund in the lineup, talk to the record keeper and say, for PIMCO Real Return, on your platform, what is the net most efficient share class? And you pick the one that's the most, net cheapest. But for the funds that do share revenue, in this scenario, where the funds that do share revenue come to 228,000, which is 9 basis points, that's credited back to the participants every quarter, okay? And so with the weighted cost of 45, and where they credit back 9 basis points, the net cost of participants is 36 basis points. So I'm going to go on to the next attachment, if there isn't any questions.
Well, can you talk about the big yellow line on this?
Yes, I will. And I'll talk to that at the end as well, but I'm glad you brought that up. So, the 98 million, that's that glaring, between the three record keepers, we've got 98 million in stable value, of which 79 million is in the Nationwide, okay? And so, of the 79 million with Nationwide, Mass Mutual, thank you. Of the 79 million in the general account, yes, you enjoy the 4% trading rate, but there's no cost associated with that. And if there was a cost associated with it, the improvements would be all that much. There would be even more kind of meat on the bone to improve that if there was a quantifiable implicit cost to the general account, but there's not. In this example, Mass Mutual, this is not their general account. This is their insurance company's separate account, which is somewhat different. It's still the same portfolio, but your assets aren't part of the general account. So if, in a way, when the financial crisis happened, Hartford was basically insolvent and they had to take the TARP money. Otherwise, they would have gone under, and the city of Las Vegas would have had to, get in line as a general creditor, and maybe accept, cents on the dollar for your participants. That's the trade-offs of the general account. You get a high crediting rate, but you're a creditor to that as well. In an insurance company's separate account, you get the same portfolio, but the assets are segregated from the general account. And if, in fact, you did have to redeem or you wanted to move the account and the market value was below the book value, you would then look to the general account to make up that difference, okay? You generally get a less crediting rate for that, trade-off, but it does come with an explicit expense, which offers transparency. So in this particular case, this is hypothetical, and as long as I was using a record-keeping quote from Mass Mutual at 5 basis points, I figured I would also use their Mass Mutual Diversified SAGIC separate account in this example that comes with a cost of 25 basis points that equates to 246,000. I mean, that's a number.
What's a good return?
The crediting rate is 3.3%. Okay, so it's based on where market rates are. It's pretty compelling. It's not 4, but it's pretty attractive. So on the next page, or actually, I'll go to the third attachment. So under the current costs, we've got 261 million at a weighted expense of 57 basis points is on the current cost sheet. 1,479,000. You have to include the 15,000 that the city's paying, so you're at 1,494,000. Those are the total plan costs. The proposed costs that in this hypothetical situation is that from the proposed spreadsheet, you take the net weighted of 36 basis points. That's after the 9 basis points is credited back to participants. You then take the 8.4 basis points. That's the total of the hypothetical record-keeping fee of 5 basis points plus the 3.4 to Morgan Stanley. That's 8.4. So that's a total of 44 basis points. That would be an asset-based fee around participants. So the total plan cost would be $1,165,000. You subtract that from the $1,479,000, you're looking at an annual cost savings of $313,000, which is 21%. Now that is compelling, and I think that would, pique a lot of people's interest, whether it's city council or anybody opposed. If they really knew the opportunity, I think you'd have some intent listeners. Now, what throws a wrench into this particular scenario that we simply can't avoid the fact that Mass Mutual at 79 million, credits 4%, Nationwide 7.1 million, credits 3.3, ICMA 189. You've got a blended weighted crediting rate of 369, which provides income to the plan of 3.6 million every year. So you can't just turn a blind eye to that. You have to compare that and evaluate that in the context of the savings you can get from the top half of the sheet. So when you look at the cost savings of 313,000, which is 21%, and you offset that by if you were to use the diversified SAG 2, which yields 3.3, you're actually giving up 383,000 in earnings to the plan. So when you offset both together, you're 69,000 to the negative.
You shot yourself in the foot.
Well, I have to present the numbers as they are, but now you could say, well, there goes the argument. You can't do it. But you could also look at this from the point of view that transparency is a big thing right now with the DOL. It's a fiduciary concern for sure. It's not an apples-to-apples comparison because the 79 million doesn't have an implicit cost to it.
For the cost of being born by the other participants and the other funds.
Well, there's another fiduciary point of view.
It's a subsidy.
It's a subsidy, yeah. But at $69,000, which is 260 million, is a rounding error. But you have transparency. And by the way, in this example, I use Mass Mutual SAG. I know what the crediting rate is. It's 3.3. I know what the expense is. It's 25. I think it's a 10 basis point asset fee and a 15 basis point insurance wrapper fee. 25 all in. But in this same RFP process, Mass Mutual, which is not the Hartford, it's the modern, Reflex Mass Mutual, whether you like them or not, they do quote this, drop-down rate where the first year is a 3.9 and the second year is, 3.8. And so if you take those and amortize a blended rate over a 5-year period, this would look even better. And that 69,000 deficit would be a positive, essentially.
You're saying the proposal that you've seen from Mass Mutual?
Yeah, correct.
I don't know if you realize
That's
they were
true.
the one who did.
That's correct, and that's using their general account. So if you did that, the proposed scenario that this 98 million comes with a 25 basis point cost and the $246,000 cost associated with that would go away. So everything's a trade-off. And so City of Henderson was a huge success, and what we have the benefit of now is knowing the process. I have a great RFP document that you could use on Nevada Gov if that's your procurement, okay? We know the process. We have the benefit of knowing that participant education deck that Henderson authorized me to share with you. We have the benefit of being here for a few years, knowing the council, committee members that have been through this, and I would brief council. I would do anything I can. So I guess my message is, we're never going to know how this can shake out unless we took another crack at an RFP process. And I think we're in a better place to do it. And as far as you being here, Vanetta, and being part of a quorum that would vote, a motion could take a lot of different forms. But one motion could say, let's pursue this into 18, and if you want to come up with a strategy that makes sense, given the politics within this city, to disseminate information and do it differently than we did the first time that didn't work out. With the idea to continue to gain traction and look at a conversion for like a 1-1-19. Otherwise,
Remind us, what was the blended rate or what was the rate for the winner that Prudential gave to Henderson?
The winner.
Was it Prudential?
No, the winner was Empower.
What was the rate that they gave?
Well, it's interesting because in Empower's proposal, the city in that particular case ended up going with their non-proprietary quote. The quote that was higher record-keeping quote that wasn't dependent on Henderson being connected to Empower's general account. So they took slightly higher record-keeping fee that was still so much lower than their weighted 33, and with that they got to use a non-proprietary, and in that case we're actually using MetLife's separate account that comes with a crediting rate of a 263. That is still it's in the high twos. I can't remember offhand, but the numbers worked out in their case. But they had their net crediting rate wasn't a 369 with 89 million in it. They had 25 million in it at a lower blended crediting rate. So
what was their record keeper cost for this non-proprietary plan?
Theirs was.
Trying to figure out how realistic the five in your example is.
Yeah, it was about 5. Yeah, I mean, 5. I mean, I'm always going to be realistic.
What was the spread on the top 4? Were they really far apart? Were they pretty close? How did they? What made Henderson go one way or another?
It was a combination between a lot of things. It was costs were one of them, and it wasn't just record-keeping costs. It was a blended cost between the record-keeping fees and also the crediting rate on the fixed fund. It was a demonstration of the participant website that thought was robust. It would offer the best participant experience. It was the presentation. It was the demonstration of how a record keeper would put forth a really good education strategy, move the needle, setting a benchmark, a baseline on participation rate, deferral rate, diversification as a benchline, and how they would move the needle and how they would execute on that. All those things.
Does Empower have any other entities in the valley?
Yeah, I think they have North Las Vegas.
My state of Washington plan has Drew and Power. Washington dropped ICMA on Drew and Power.
Yeah.
So
But,
Henderson only has one, no nationwide, no,
well, they have three now, but they're gonna have
I
one.
mean, one, they're going to have.
They had Sequoia and Nationwide.
And ICMA.
ICMA.
Yeah. Can you imagine the ease of administration? One record keeper, that we could come in and have, make them, ask them to present, one time a year, and just the efficiencies, the length of committee meetings, actually spend less time on reviewing funds and talking more about trends and issues and fiduciary concerns.
So it seems like the benefit, the financial benefit of this move potentially is very dependent on whether or not we believe Mass Mutual is going to continue to give us 4% or not.
It's a big part of it.
And sooner or later, if not.
They probably will in the short term because they're investing that money in the stock market and getting a ton of money out of it now.
Well, fixed income market's done pretty well. I'm sure the general account portfolio is performing, pretty well now. And
Well, I was told by Hartford people that a lot of the money that's in that is actually the money that they get from their insurance products.
well, it is, because you've got, that's what the general account is. You've got, Mass Mutual being such a big insurance company, you've got insurance contract holders and annuity contract holders. They pay premiums. Somebody dies if they have a benefit. In the middle, they invest all that money, of which you've got $79 million lumped into that. It's part of that.
But I mean, they're taking that money they're receiving from annuities and stuff and investing it. And so they're getting good rates of return right now.
Right.
So they're probably fairly comfortable paying 4% and have $80 million of our money to invest with the way the market's been for the last couple of years.
Yeah, I think, realistically, I think $79 million.
All in the grand scheme of
is
things,
nothing
then
to
it's
them.
like rounding error in the
Yeah.
portfolio.
Yeah, but if you're looking at it, if they're looking at managing their book of business and got this one, white element of the city of Las Vegas,
It's
if
still
they,
much as it is at 4%.
you think so?
One of my last weeks to
Okay. Well, then, that's, and then, the other plans in their book of business that are, paying out market rate, 3, let's say, is subsidizing where they have to pay out 4. Yeah. And
But it's not really paying, it's not really paying for it, because it's assumed it's like these other general accounts, it's probably got a 40 or 50 basis point fee, they're just getting that 40 basis point fee off of people in the funds through their record keepers.
you could say that they're charging higher record keeping fees to support that, but you could also say that the cost to participant that you could never really prove, because it's not specific, it's not implicitly quantified. The real cost is the spread. That
So at the end of the day, the general plan participants are subsidizing the general account investors.
within City of Las Vegas?
Yes.
It's the
On
opposite.
the opposite,
The
yes.
people that are not in the general account.
Yeah, the people not in the general account are subsidizing the general account holders to the tune of
57 basis points. And the general account investors are enjoying the ride of getting 4%, not paying anything. The other thing to
Of course, if
consider,
they could handle the risk, they could have been making 20%.
yeah. The other thing to consider is that if you were to apply, this strategy, that even if you,
Do we know the percentage of people in the 4% account that are retirees versus active employees? Because this plan is for active employees, not necessarily for retirees. I mean, it's for retirees, they keep the money there, but the plan is really to benefit the active employees.
yeah, we're gonna find that out.
It's both, but it seems like this is skewing it into a, I don't know, just
Yeah. Number of people in general account and how many retirees.
active versus
Yeah.
You have to see the dollar value.
in dollar value. That's really the key is the dollar value.
Yeah, and the other thing to consider is that let's suppose you never change record keepers, and you abandoned the revenue model that we've inherited, dependent upon the record keeping, revenue sharing to the record keeper Morgan Stanley that we know is 57 basis points because the revenue sharing 22 isn't going to the participants. And we never made a record keeper change and just adopted and implemented the more efficient way to use more of a zero revenue share lineup, or if there's a fund that shares revenue, credit back to participants, clear that out every quarter, and then apply that asset-based fee. You're still going to get lower the net cost, even if you don't get lower record-keeping costs, but we can't because with the Mass Mutual on the old Hartford platform, that platform can't accommodate it. We've been through that, so we're stuck.
But they'd be happy to move us to the Mass Mutual platform if they were.
That's right.
Sign a long-term contract.
If we do that, we may as part of that.
Right.
Yeah, and by the way, when this plan was originally set up, the liquidity provisions for that general account was a market value adjustment. Now, book to market ratios right now are still over 1. Because we've got a very healthy fixed income market of low rates and tight credit spreads, but at some point things are going to get overheated, and those credit spreads are going to widen, and if rates go up, the book could go under, could be less than the market, the market could be less than the book, and if you had to move that, you're not going to give a participant 98 cents on the dollar. No plan sponsor would do that. It would typically take you 5 years on a 5-year spread pay to make them whole. Well, I have a letter that states that a few years back, Mass Mutual signed an amendment that went to a 12-month put. That's nothing. 12 months goes by, really quick. So, and actually, if you ever terminate with Mass Mutual, it's concealed. They may even waive the 12-month put because they'd like to, just place that that $79 million with a new client, and pay him 3.5 instead of 4.
During the focus meetings at Henderson, what was some of the feedback from the employees relative to consolidation? What did you hear?
That's a great question, Vince. We got questions. There was no real pushback because we were so forthright to begin with. But some of the questions were, will I have access to the same funds? Potentially, we'll be looking to, retain some of the funds that are performing well. If not, we'll try to identify a better performing fund to replace them. Oh, okay. Will the value of my account change? No, because if we, map your assets, the value of your account is going to reflect, the market levels the investments are in, the market value, the market
Not on
levels.
day one.
Huh?
Not on day one.
Well, today there's only really one day that they're out of the market in today's conversion process. One day, and they can only hope the market goes down, right? Let's see, what were some of the other questions?
Was there one of those 3 plans that was a